Did you know that Canada's commercial real estate sector supports over 1 million jobs and generates nearly $200 billion in GDP? This makes it a major economic driver, comparable to the oil and gas industry. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. Today we're diving into a fascinating article by Peter Norman, Vice President and Economic Strategist, titled CRE as a Catalyst: Jobs, Investment, and Policy in a Shifting Canadian Economy. This research was shared at the NAIOP CRE Converge conference and highlights how Canada's commercial real estate sector is driving jobs and investment while facing policy, demographic, and economic challenges. Canada's population growth, which surged right after the pandemic, has now slowed significantly. Federal policy changes are expected to bring near-term growth close to zero, affecting housing, labor, and commercial real estate demand. This slowdown raises essential questions about the timing and necessity of such policy shifts, especially during a period of economic uncertainty. Trade policy has also added to the uncertainty, with protectionist rhetoric unsettling Canadian businesses even before tariffs formally took effect in early 2025. This has led to stockpiling, slowed investments, and a contraction in Canada's economy during the second quarter of this year. Despite this, retail spending has held up well, showcasing the resilience of consumer demand. Labor markets are feeling the strain too, with youth employment dropping significantly. This decline raises concerns about the long-term resilience of Canada's labor force, which could impact office demand and retail activity. However, older workers are staying in jobs longer, somewhat balancing the picture. Commercial real estate remains a crucial part of Canada's economy, supporting jobs through direct employment in construction, property management, leasing, brokerage, and operations. It also has indirect impacts through upstream industries and induced impacts as workers spend their wages locally. Together, these factors generate nearly 7% of Canada's GDP. Despite its vital role, the commercial real estate sector is facing significant pressure. Transaction volumes have fallen since 2021, with office deals particularly affected. High borrowing costs and elevated cap rates are squeezing returns, and uncertainty around growth has kept investors cautious. In the office sector, the challenge of functional obsolescence is acute. With about 100 million square feet of office space sitting vacant in Canada, the need for more flexible regulatory environments to accelerate conversions and redevelopments is evident. This could pave the way for new, high-quality office projects that meet modern demands. Multifamily, retail, and industrial sectors present a more nuanced picture. Multifamily construction has grown, spurred by tax policy changes like the 2023 GST/HST rebate, though financing remains challenging. Retail investment has held steady due to resilient consumer spending, while the industrial sector, particularly logistics, data centers, and cold storage, continues to attract capital. The takeaway from Peter Norman's research is clear. Commercial real estate is a pillar of Canada's economy, supporting jobs and driving investment. However, the sector is navigating significant strain, and thoughtful policy choices will be crucial in determining whether it gains momentum or remains constrained. More flexible planning rules, faster approval processes, and policies encouraging both new investment and adaptive reuse could unlock opportunities. Let's shift our focus to an important development from the Canada Mortgage and Housing Corporation, or CMHC, that could significantly impact homeowners and small rental property owners. CMHC has introduced a product called CMHC Improvement Mortgage Loan Insurance, designed to provide greater financing choices for new construction and home improvements. This initiative aims to make it easier for homebuyers to finance their residential property purchases or improvements with lower down payments. The CMHC Improvement product offers insured financing up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties, and up to 90% for 3 or 4 unit properties. This means that buyers can secure financing based on the future value of their home after improvements, rather than just its current value. It's a significant shift that could open up opportunities for many prospective homeowners. What's particularly interesting is the flexibility in advancing options. For small or large-scale improvements and new construction, CMHC offers both single advance and progress advance options. For improvement costs that are 10% or less of the as-improved value, single advances are used. For costs greater than 10%, progress advances come into play, allowing for multiple disbursements as the project progresses. Another key feature is the requirement for a new home warranty for all new homes, which ensures that the construction is up to standard and provides peace of mind for buyers. This requirement applies across all provinces and territories where such programs are available, and alternative documentation is needed in areas where it is not. When it comes to eligibility, CMHC improvement is available to Canadian citizens, permanent residents, and those authorized to work in Canada. The loan-to-value ratios vary depending on the type of property and whether it is owner-occupied or not. For instance, owner-occupied properties with 1 to 2 units can have a loan-to-value ratio of up to 95%, while non-owner-occupied properties can go up to 80%. This initiative by CMHC is a positive step towards addressing housing affordability and providing more Canadians with the opportunity to own and improve their homes. By offering more flexible financing options and supporting home improvements, CMHC is helping to stimulate the housing market and support economic growth. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.